You would typically think a flight to safety is the kind of thing that would push up the dollar, hurt earnings prospects for corporate America. Why is the opposite happening now? And could that give us a little bit of an offset here in a good way?
Well, the answer is simple. The reason why the U.S. dollar is getting sold so aggressively is because everyone seems to believe that the most aggressive stimulus, particularly on a monetary perspective, is going to come from the Federal Reserve. So they priced in the rate cuts that we've already had, and they're looking for another significant move, possibly down to zero and possibly even negative rates. So the expectations of action that hasn't taken yet on aggressive level by the Federal Reserve is causing investors to bail out of U.S. dollars. And that's something that, we're watching very closely. But unlike before, where it was a smooth one-way downtrend in this sell-off, the phase that we're in right now, there's going to be a lot more volatility because we are in high alert for central bank as well as government actions. And that could cause a lot more volatility in the U.S. dollar.
Well, I was going to say volatility might be a good thing in the markets if we finally get it to the upside. Kenny, real quickly, I want to ask you about something that Leon Cooperman talks about every time he comes on our air. He says, why not reinstate the uptick rule? The SEC should do that. He said, forget central bank action, forget fiscal. If they just did that, it would do more to help quell this kind of selling than anything.
1,000%. But the problem is the market's so fragmented, right? Remember post 9/11 when the New York Stock Exchange was really the central marketplace. Today there are 11 exchanges and 50 plus alternative venues, which are not exchanges in and of themselves. And so therefore, in a sub-decimal environment, which price are you going to use, right, to figure out the plus tick or minus tick, right? Because it trades so fast in picoseconds and it's trading in all these different venues. It's difficult to say, okay, this is going to be the price that we use, I guess.
Great point.
But it is a point. I think he's absolutely right because without the short sale rule, you get this extra downdraft and pressure on stocks that create action like you've seen today, which is mind-blowing.
I know. We're looking for adjectives. Margie, maybe you can supply them because it is shocking to see how fast we've fallen. It's one thing to say the markets were priced for a correction, and they certainly were. The speed of this one has been unusual, hasn't it?
Yes, it reminds me very much of '08, where the market went down without people understanding why. And what it says to me is we still don't have all the facts that tell us why the market's going down. And I think it shows, the virus shows its effect on so many countries in the world that are really treading water right around zero growth. They really couldn't take this virus hit. And so I think the market is reflecting negative growth and even recession in many, many countries in the emerging market and real disappointment out of China. That's what I think the market is telegraphing with this big downdraft here.
And I'm with you on all of those countries, Margie, but what about the U.S.? Maybe we were at a 2% run rate. It could have been a little stronger. Maybe it was a little bit less, but we weren't at zero. And now we've got a 16% chance of negative rates by this summer. Were we really in that bad shape? Is coronavirus going to turn out to be that severe of a hit?
Well, I think the course of U.S. rates, unfortunately, for we investors is still down. I think we're going to join that zombie land of zero rates that are prevailing pretty much around the developed world. And I think it's more an effort to provide liquidity and to ease any downdraft in our economy as you have this disruption in the supply chain.
Jim, I see you nodding your head when you heard negative and zero rates. I don't like that. Tell me why.
I absolutely do think we're going to zero rates, too. And in these pits down here, we've seen a lot of option plays that presuppose zero rates as well, too. As far as the correction and the violence of the correction, too, I think it's reasonable to assume that in 2020, normal corrections are going to be quicker and more violent just because every level of market participant now has immediate access to markets. That didn't exist even 15, 20 years ago. So to me, it seems like if it's just the normal correction and we're just trimming the hedges, that it'll be much quicker. If it's something economically that's pervasive, that could be something different.